If you own silver right now, then stop scrolling because something important is happening around the metal that many investors may still be underestimating. President Trump has made critical mineral supply chains a national security priority. His administration has taken steps aimed at securing domestic access to strategic materials and reducing dependence on foreign suppliers. That does not mean Trump has suddenly announced a direct government repricing of silver, but it does mean the policy environment around strategic materials is changing fast, and silver sits directly inside that conversation. The reason this matters is simple. Silver is not just a precious metal. Silver is an industrial material. It is used in electronics. It is used in electrical systems. It is used in solar technology. It is used in advanced manufacturing. It is also traded as a monetary asset. When governments start thinking about mineral supply as a national security issue, the market can begin to value certain metals very differently. And that is where the Trump silver story becomes much more interesting. The market has already shown just how explosive silver can become. Silver reached a record near $121 an ounce in January 2026 before experiencing a major correction. Even after that correction, silver remained dramatically higher than its 2025 levels. So when people hear the words Trump and silver in the same sentence, they should not immediately assume that the president has announced a specific silver price target. The bigger story is policy, the bigger story is supply, the bigger story is strategic materials. And the biggest question is whether silver is gradually moving from being treated mainly as a commodity toward being treated as a strategic asset. That distinction could become extremely important. Think about what happens when a government decides that a material is critical. The government begins looking at supply chains differently. Imports become a strategic issue. Domestic production becomes more important. Recycling becomes more important. Stockpiles become more important. Foreign dependence becomes a risk. And suddenly the market starts paying attention to something that investors previously ignored: available supply. That is exactly why the recent actions from the Trump administration deserve attention. On July 20th, the White House announced an executive order focused on securing defense supply chains and ensuring domestic acquisition of critical materials. The order directed greater attention toward domestic and allied sources and warned about supply chain risks created by unreliable foreign suppliers. Then, on July 30th, President Trump signed a presidential determination connected to recoverable critical minerals and materials. The White House said the United States relies heavily on imports of certain critical materials and that this dependence creates a risk of serious supply chain disruption. The determination gave the Commerce Department authority to pursue export restrictions involving recoverable critical materials. Now pause for a moment. This is where the silver story becomes more complicated. Not every critical mineral policy is directly about silver. The government documents do not say that America is suddenly setting a new official silver price. They do not establish a fixed silver price. They do not guarantee a silver shortage. But they show something important. Washington is becoming much more focused on the security of mineral supply chains. And silver is one of the metals that investors should keep watching because of its combination of industrial use and monetary demand. That combination makes silver different from many other commodities. Copper is heavily industrial. Gold is primarily monetary and financial. Silver sits somewhere in between. That means silver can react to economic growth and monetary policy at the same time. If manufacturing grows, silver demand can increase. If solar installations grow, silver demand can increase. If electronics demand grows, silver demand can increase. If investors become worried about inflation, silver can attract monetary demand. If the Federal Reserve becomes more supportive of lower interest rates, silver can benefit. And if geopolitical risk increases, silver can receive safe haven attention alongside gold. This creates a unique setup. Now add Trump's trade policies to the equation. Tariffs can change the economics of global trade. They can change where companies source materials. They can change inventories. They can change shipping patterns. They can change the cost of manufacturing. And they can change the value that markets place on secure domestic supply. We have already seen how quickly tariff headlines can move precious metals. Earlier in 2026, silver prices reacted sharply when the United States delayed new tariffs targeting critical minerals. Silver had briefly reached record levels before the tariff delay changed expectations about near-term trade disruption. That episode is extremely important because it shows how sensitive silver can be to trade policy. The market does not need a government to announce a silver price target. The market only needs to believe that the cost and availability of silver could change. That can be enough to move prices, and this is where investors need to understand something about silver that is often missed. Silver supply cannot respond instantly to higher prices. A new mine does not appear overnight. A major expansion does not happen in a few weeks. Permitting takes time. Construction takes time, financing takes time, infrastructure takes time, processing capacity takes time, even recycling takes time. So if demand rises faster than supply can respond, the price can move dramatically. That is one of the reasons silver can experience much larger percentage moves than gold. Silver is also a relatively small market compared with major financial assets. That means a large shift in investment demand can have a meaningful effect on price. And once momentum begins, the market can become very emotional. Investors see the price rising, they see headlines, they see charts, they see forecasts, then more investors enter. That creates more momentum, and momentum can attract even more momentum. This is how commodity cycles can become explosive. But there is another side. Silver can also fall very quickly. That is why anyone watching this market needs to understand the difference between a strong long-term thesis and a short-term trading move. The long-term thesis can remain intact while the price experiences a major correction. We saw that after silver reached its January 2026 record. The metal later experienced significant downside volatility. Recent market data showed silver trading around the mid-$60 area in August after the huge move earlier in the year. Even after the correction, silver remained more than 70% above its 52-week low. That tells us something. Silver is still in an unusually volatile environment, and volatility is not automatically bullish. It simply means the market is moving aggressively. The next major factor is the Federal Reserve. This is where the Trump silver story connects to monetary policy. The Federal Reserve held its policy rate at 3.50% to 3.75% at its July 29th meeting. The decision passed by a 9-3 vote. 3 officials preferred a quarter-point rate increase. The Fed also said inflation remained elevated relative to its 2% goal. That is a very important detail. The Fed is not looking at a completely calm economy. Inflation remains a problem, energy costs remain a risk, economic uncertainty remains elevated, and policymakers are not completely united. That creates a difficult environment for precious metals. Normally, higher interest rates can pressure gold and silver. Why? Because metals do not pay interest. When Treasury yields rise, investors can receive more income from government debt. That increases the opportunity cost of holding metals. A stronger dollar can also create pressure. But there is another side. If investors believe that the economy is weakening, then expectations for future rate cuts can support metals. If real yields decline, gold can benefit. If the dollar weakens, gold can benefit. Silver can benefit as well. And if industrial demand remains strong, silver can potentially outperform gold. That is the key difference. Silver does not need one single catalyst. It can receive support from several directions. Now think about inflation. Suppose inflation remains above the Fed target. Suppose economic growth begins slowing. Suppose the Fed cannot comfortably raise rates without creating more economic stress. That is a difficult environment. The central bank has to balance price stability against economic stability, and precious metals can become more attractive when investors believe policymakers have limited room to maneuver. This is why silver investors watch the Fed so closely. The next scheduled FOMC meeting is September 15th and 16th. That meeting will be important. But the market will not wait until September to form expectations. Traders will study every inflation report, every employment report, every retail sales report, every major economic indicator, and every statement from Fed officials. If the economic data weakens, then expectations for easier policy could increase. If inflation rises again, then expectations for higher rates could increase. Silver will react to both. This is why the dollar is also critical. The US dollar is one of the most important variables for precious metals. When the dollar strengthens, silver can face pressure. When the dollar weakens, silver can receive support. But again, the relationship is not perfect. Sometimes silver rises even while the dollar is strong. That happens when another force becomes more powerful. Supply concerns can do it. Industrial demand can do it. Geopolitical risk can do it. Investment demand can do it. And policy uncertainty can do it. This is why simply looking at the dollar is not enough. You have to look at the entire system. Now let's talk about industrial demand. This may be the most important part of the silver story that many investors underestimate. Silver is essential to modern technology. It has excellent electrical conductivity. It has excellent thermal conductivity. It is used in electronics. It is used in electrical contacts. It is used in solar applications. It is used in automotive technology. It is used in telecommunications. It is used in advanced industrial systems. The world is becoming more dependent on electricity. That matters. More electronics means more silver demand. More solar capacity means more silver demand. More advanced technology means more silver demand. And if governments increasingly view supply chains as national security issues, then the strategic value of reliable mineral supply becomes even more important. The Trump administration has already emphasized domestic production and supply chain resilience across critical materials. This does not prove that silver prices must rise, but it creates a structural theme worth watching. Now imagine a scenario where the United States wants more domestic production of critical materials. Mining companies receive stronger incentives. Recycling becomes more important. Imports become more complicated, global supply chains become more fragmented, and industrial demand continues growing. What happens to metals that are difficult to replace? They become more strategically valuable. That does not mean silver becomes a government-controlled asset. It means the market may start assigning a higher value to supply security. That is a very different idea, and it is one of the reasons silver deserves attention. There is also another important factor. The world is not only dealing with economic uncertainty, it is dealing with geopolitical uncertainty. The Federal Reserve itself recently cited elevated uncertainty related in part to the conflict in the Middle East. Geopolitical risk can affect silver in several ways. It can increase safe haven demand. It can disrupt supply chains. It can increase energy costs. It can increase inflation expectations. And it can change investor behavior. Gold usually receives the strongest immediate safe haven reaction, but silver can follow. And when silver begins moving after gold, it can sometimes move much faster. That is because silver is a smaller market. It has more industrial exposure, and it is more sensitive to changes in investor positioning. This is why you should not look at silver as simply a cheaper version of gold. Silver has its own cycle, its own demand structure, its own supply dynamics, and its own risks. Now let's talk about the gold to silver ratio. This is one of the best tools for understanding whether silver is beginning to outperform gold. If the ratio rises, then gold is becoming more valuable relative to silver. If the ratio falls, then silver is gaining relative strength. During major silver rallies, the ratio can fall sharply. That is important because it tells us that investors are becoming more aggressive inside the precious metals sector. Gold is usually the defensive leader. Silver is often the high beta follower. When silver starts leading, then the market can become much more speculative. This does not mean the rally must continue, but it can tell us that momentum is changing, and that is exactly what investors should watch now. Do not just watch whether silver goes up. Watch whether silver outperforms gold. Watch whether silver holds its gains after strong rallies. Watch whether buyers appear during pullbacks. Watch whether industrial metals are also strengthening. Watch whether the dollar is weakening. Watch whether treasury yields are falling. And watch whether the Fed becomes more concerned about economic weakness. Those signals together are much more powerful than one headline. Now let's return to Trump. The biggest mistake would be to say that Trump has officially announced a silver revaluation when the evidence does not support that claim. That would be misleading. The more accurate story is that the Trump administration is pushing a broader strategy around critical minerals and domestic supply security. That strategy can have implications for silver because silver is deeply connected to industrial supply chains. The administration has already taken action involving critical materials. It has emphasized domestic and allied sourcing. It has pursued policies aimed at reducing dependence on foreign suppliers. And it has expanded the national security framing around mineral supply. That is the real story. And sometimes the real story is more important than the headline, because policy can change the structure of a market slowly. At first, investors barely notice. Then companies begin changing supply chains. Then manufacturers begin signing long-term contracts. Then inventories become more important. Then governments start building strategic relationships. And eventually, the market realizes that the underlying economics have changed. Silver could benefit from that process if supply becomes more strategically valuable while demand continues rising. But there are risks. A global recession could hurt industrial demand. A stronger dollar could pressure prices. Higher real interest rates could pressure investment demand. A major increase in mine production could ease supply concerns. A sharp fall in solar or electronics demand could reduce industrial consumption. and a major change in geopolitical conditions could reduce safe haven demand, so the bullish story is not guaranteed. That is why responsible investors should avoid thinking in absolutes. Silver can go higher. Silver can also correct. Both statements can be true. The key question is the time horizon. Over the short term, silver can move based on futures positioning and headlines. Over the medium term, silver can respond to Fed expectations and economic data. Over the long term, silver depends heavily on supply and industrial demand. That is why this market needs patience, and this is also why chasing a massive green candle can be dangerous. If silver suddenly jumps 10% or more, then a pullback should not be surprising. Markets rarely move in straight lines. A healthy bull market often contains sharp corrections. The question is, what happens after the correction? If buyers return quickly, then the trend may remain strong. If support fails and selling accelerates, then the market may need more time. This is where technical analysis becomes useful. Look at previous highs, look at previous lows, look at major moving averages, look at volume, look at momentum, look at how price reacts around major psychological levels. But never let a chart replace the fundamental story. The chart tells you what the market is doing. The fundamentals help explain why. Right now, the fundamental story is unusually complicated. The Fed is balancing inflation against economic risks. The dollar remains critical. Treasury yields remain elevated. Geopolitical uncertainty remains significant. Industrial demand remains important. And Washington is placing greater emphasis on critical mineral supply chains. That combination creates a very unusual environment for silver. It also creates the potential for very large moves. But remember something important. A government focus on critical minerals does not automatically mean silver is about to double. A tariff does not automatically mean silver prices must rise. A Fed pause does not guarantee a silver rally. And a strong industrial demand story does not eliminate short-term volatility. The market has to confirm the thesis. That confirmation comes through price. It comes through volume. It comes through relative strength. It comes through physical demand. It comes through investor positioning. And it comes through the behavior of silver when negative headlines hit. That last point is especially important. If silver stops falling when bearish news appears, then buyers may be becoming stronger. If silver rises on neutral news, then momentum may be increasing. If silver holds its gains, even when treasury yields rise, then demand may be stronger than expected. If silver begins outperforming gold, then the precious metals cycle may be shifting. Those are the signals I would watch. And there is another major question. Could silver eventually become treated as a strategic material rather than simply an industrial commodity? That question is impossible to answer with certainty, but the direction of policy makes the question more relevant. Governments are increasingly thinking about supply chains. Technology is increasing mineral demand. Energy systems are becoming more electrified. Defense systems require specialized materials, and geopolitical competition is making dependence on foreign supply more sensitive. Silver is part of that broader world. That is why this market could remain important for years. So if you own silver right now, do not focus only on today's price. Focus on the structure underneath the price. Focus on the Fed. Focus on the dollar. Focus on inflation. Focus on treasury yields. Focus on industrial demand. Focus on mine supply. Focus on recycling. Focus on global trade. And focus on Washington's critical mineral strategy. Because those are the forces that can determine the next major